Walk through any major Indian city today, and you'll see concrete rising. The real estate market is undergoing an aggressive expansion. But if you look at the stalled sites and idle cranes, you can see the structural vulnerabilities baked into how these projects are funded. Top-line revenue across the sector looks spectacular, with developers reporting record-breaking sales. But in real estate, revenue can be a vanity metric. A company can sell thousands of units and still be inching toward bankruptcy. To understand why, we analyzed the financial statements of 6 major developers from 2021 to 2025: Oberoi Realty, Brigade Enterprises, Godrej Properties, Prestige Estates, Sobha Limited, and Puravankara. They all build at scale, but their business models couldn't be more different. Every investor in this space has to choose between 2 paths: prioritizing capital efficiency and safety, or chasing aggressive scale fueled by leverage. This quadrant chart maps those paths. The vertical axis measures cash flow quality, the actual cash the business generates. The horizontal axis tracks leverage, or the debt-to-equity ratio. The outliers are extreme. In the top left, Oberoi Realty sits isolated with high cash and minimal debt. In the bottom right, Puravankara is trapped by heavy borrowing and negative cash flow. Rapid growth is an empty metric if it destroys your cash reserves. In this industry, survival is determined by the business model you deploy. Oberoi Realty uses a premium concentration model. They focus exclusively on ultra-premium developments in Mumbai and fund their construction with minimal borrowing. By maintaining pricing power and avoiding debt, Oberoi achieves operating margins of 58.7%. They keep more than half of every rupee they earn before taxes and interest. Contrast that with Puravankara. They financed mid-premium land acquisitions with high-interest debt, leading to a net loss of nearly 180 crore rupees in 2025. Real estate survival depends on the interest coverage ratio. This measures whether a company earns enough operating profit to pay the interest on its loans. If this ratio drops below 1.0, the business is effectively suffocating. This comparison shows the gap in survivability. Oberoi earns 12 times what it owes in interest. Puravankara's operating profit of 291 crore covers only half of its 555 crore interest bill. Puravankara bought land using debt, but their sales velocity didn't keep pace. The inventory piled up, but the cash collections never arrived. When operating profits can't cover bank loans, the money must come from the balance sheet. Puravankara's equity dropped from 2,042 crore to 1,731 crore as it was consumed by interest obligations. When you buy a real estate stock, you are buying an operational philosophy. A flawed philosophy can quickly vaporize shareholder equity. Between the two extremes, developers like Godrej and Prestige use capital-light scale. They utilize joint development agreements, or JDAs, building on land owned by partners rather than buying it themselves. The benefit of this model is speed. Without high upfront land costs, Godrej achieved a 59.3% revenue growth rate, allowing them to expand across India. This chart compares Godrej's top-line growth against its actual cash operations. While revenue skyrocketed, their cumulative operating cash flow reached negative 6,918 crore over 5 years. To sustain this, they have to constantly issue new stock, diluting existing shareholders. But aggressive scale also creates a backlog. Both Godrej and Prestige are currently managing inventory overhangs exceeding 30,000 crore rupees, creating years of execution risk. Sobha Limited chose a different path: vertical integration. Sobha handles 100% of construction and material sourcing in-house. This allows them to maintain low debt and collect payments quickly because they rarely miss construction milestones. However, this model has a specific vulnerability. When raw material prices spiked, Sobha absorbed every increase in steel and cement costs internally. Their operating margin dropped from 32% to just 7.3%. Rapid scale creates a cash flow trap, while total operational control creates a margin trap. Neither approach is a guarantee of safety. To understand Puravankara's distress, you have to look at their debt-to-equity ratio, which has reached 2.50x. The metric that breaks a leveraged developer is inventory velocity, how long it takes to convert raw land and poured concrete into actual cash. This funnel illustrates the bottleneck. Puravankara has over 10,000 crore rupees locked in work-in-progress inventory. It currently takes them 1,935 days, over 5 years, to convert that into revenue. When cash takes 5 years to materialize, the daily costs of labor and overhead still must be paid. The company is forced to take on even more heavy debt just to keep the daily construction moving. During this liquidity crunch, management paid out 149 crore in dividends. Since retained earnings were negative, those dividends were effectively funded by taking on more debt. The math eventually breaks. While revenue grew 109% over 4 years, operating profit grew only 3%. Rising interest costs are now consuming the margins entirely. A debt-financed model without rapid sales velocity is not a viable business. It is a countdown to insolvency. Puravankara has a 36-month roadmap to attempt a recovery. This plan prioritizes immediate survival over long-term growth. Phase 1 requires selling off 400 to 600 crore in land assets and issuing new stock, which will force existing shareholders to accept a 15 to 20%. The evidence suggests that conservative investors should avoid developers with negative operating cash flow, regardless of how fast their revenue is growing. Conversely, high-risk investors might see Puravankara's distress as a deep value opportunity, betting on the success of the 36-month survival plan. If you take that bet, you must monitor their quarterly results. Watch the debt-to-equity ratio and the cash flow. Do not allocate capital you cannot afford to lose. Capital should be allocated based on the structural integrity of a balance sheet, not on the size of the projects a company promises to build.